Hello, welcome back for those of you who are back to Smart Money Moves. And for those of you who are here for the first time, welcome. My name's Doug Lennick. Adam Recker, you notice, is not here. For those of you who were expecting him, he's not feeling well, but we are in good fortune to have Tim Ailes. Tim has been a guest in the past. Tim is an accredited behavioral financial professional, which is akin to a behavioral financial advisor, as I am a BFA, much like CFP and CFA are related. Tim also has deep expertise on the technical side, and he's going to take us through a lot of what you would have gotten from Adam. And I personally will tell you, I've had a chance to be in the same conversation with Tim on several occasions. The guy's really good. So, Tim, thanks for joining us. You want to say hello to anybody, or you got any fans watching?
I do not, but hello everybody, and hopefully you'll feel better, Adam.
Yeah, feel better, Adam. So let's talk about what investors are navigating right now. So I'm going to have you work through a lot of these charts and things, but I love this slide because it certainly tells the storm. So what do you have to say here?
Well, so the concept what we're talking about today is just that sentiment is low yet markets are high. So how do we make sense of what that disconnect is? And the reality is if you're feeling anxious right now, you're not wrong and you're not alone. I mean, grocery bills, borrowing costs, headlines about conflict overseas, those are all real things.
Yeah,
And
so that consumer sentiment, I think we have a slide. That's the next slide. I think we do.
yeah,
There it is.
we're just gonna try to untangle what what's the difference between what households and what you're living through and what portfolios are actually priced on. And what you're seeing here is consumer sentiment just printed some of the lowest readings in the 70 plus year history of the survey. And the S&P 500, as you're probably well aware, has reached all-time highs in the last couple of weeks. Now, most people think that one of those has to be wrong. I mean, you look at the headlines and say there's a lot of bad news out there. Stocks should not be this high. But the reality is neither is wrong on this. And by the hopefully at the end of the 30 minutes here, you're going to see why both can be true at once and why acting on the first would have actually cost you in the second. So you see here before 2020, these two lines mostly were moving in tandem. But since 2022, they've fully divorced from each other. Sentiment ground all the way down to 49.5 in the survey readings, while the S&P total return marched to new all-time highs. So if sentiment alone, the bad news that you're feeling, the things that your neighbors are talking about were a reliable guide to the markets, that purple line would have likely kept you out of the orange one. And instead, everyone who just waited to feel better before investing missed one of the strongest multi-year rallies that we have seen in a very long period of time.
Well, and the thing about waiting until we feel better to invest, is I know a good friend of mine from the past, my past career, Ted Truscott, would always say everybody, wants to be buy high, sell low, but everybody's, wrong on the turn. So we just can't pull it off. And so I really appreciate you commenting on this. And that leads us into thinking about the kinds of stuff, US, international. A lot of people kind of poo-pooed the international world of investing, but this would suggest otherwise.
Yeah, they did for years. Investors asked why even bother owning international stocks. And this year really is the answer. Like you don't diversify because of what led last decade. You diversify really because you don't know what's going to lead the next decade. So that's what we try to do here at TMG is make sure we have that global approach.
Well, and the whole concept of smart money moves and the TMG approach, which is we want to support our clients such that whenever they need money, there will be a smart place to get it. So
Mm.
the smart money moves, and we don't predict the future. We have hypotheses about it. But what we do is prepare for it. And that's what this allows for us. We're preparing based on what likely will happen versus what did. That I like this. This, of course, everybody loves this. We're talking oil. Come on, Tim.
So yeah, we wanted to show this one, number one, just to see how volatile oil and gas prices are. I mean, when gas spike it feels like the world is about to fall apart or fall off a cliff because gas is that one price that's posted on every, on a foot tall sign at every street corner in every town every day as you drive through town. So oil moves really how we feel. It changes how we feel oftentimes. But when you watch the actual inflation lines, they grind ahead very steadily. So you see in this chart, gas is up about 28% cumulatively over this time frame, which is about 5% a year. The consumer price index is up 22% cumulatively, which is a bit over 4% a year. So when an economist says inflation is cooling, they mean the annual rate. But when your neighbor says everything's expensive, they're talking about that cumulative pile. It's the same chart, but very different columns. So that 20 plus percent cumulative increase over 5 years, it's real. It's real
Well,
dollars.
and by the way, I think and we'll see this later too, this inflation line, what is important to recognize is even when the rate of inflation slows as it moves from left to right, you'll notice it still slopes up.
Yeah.
Sometimes it slopes up a little less steeply than others, but it's still sloping up. And those other lines, the prices, they fluctuate. You'll find the same thing to be true about investments. Equities will go up and down, bonds will go up and down, but that inflation line is going to continue to be relentless. And that's guaranteed that it will lock it in and it doesn't it slows sometimes, but we don't experience it dropping to deflation, luckily.
Right. And one thing to keep in mind too is that inflation is always categorized as something terrible, and it really is for savers. But people who are investors, I mean, one person's higher cost through inflation is actually another person's higher income. And all inflation is doing is it's centralizing where the wealth goes. Think about an oil company. We're all paying higher prices at the gas pump, but the oil companies is where the money's being centralized. Or let's say coffee prices go up. We're all paying higher prices at Starbucks or Pete's or the local, coffee roaster, but the person selling the coffee bean has the exact same coffee bean. They're just getting more money for it because the price of that coffee bean goes up. So just one of the things that, inflation at all times isn't the worst thing in the world. It's just a matter of making sure you know how to take advantage and benefit from just the natural cause of inflation that will always be in the system because of the way our system works.
Well, and I think that was really a nice explanation. And I like this idea of naming the disconnect. And after having talked about this earlier, it reminded me years and years ago, we used to talk about the difference between a recession and a depression. And I don't know if you did this, Tim, but we always said a recession is when your neighbor's out of work and a depression is when you're out of work.
Uh,
This is not quite like that, but sort of. Comment on this.
I believe this is someone, this gets credit to someone at Schwab, but the vibe session and the vibe what they're talking about is there's a good vibe in the economy, but it feels like a recession. And that's now changed to a vibe, which is, well, things seem good, but it feels like a depression because sentiment's been down. Things have felt bad for years now. Recall that previous chart where that sentiment has collapsed and it's been staying low for years. But what you see here on this chart, every item on the left is a real household experience. You and I are all feeling that. And every item on the right is what the aggregate data shows. The economy is still growing, earnings are beating, unemployment is steady, markets are near highs. The mistake isn't feeling the left column. Like we all feel that. What the mistake is, it's making portfolio decisions as if the left column were the right column. So making some, feeling that left side and going, I need to change something because I feel this on the left side. Therefore, I need to ignore what's actually happening on the right side of that chart.
Well, and people make investment decisions quite frequently because of what they are feeling.
Right.
And you made the point already, which is a good one. I'll say it. There are times when your money buys more ownership of the company that makes the product than it buys of the product.
Right.
So if I'm buying soup, for example, I might want to use my dollar to buy a share of their stock versus to buy a can of their soup.
Right. Yeah, and
So
that comes up quite profoundly in the next few slides. Absolutely.
let's take a look. I like it. Price
Well,
levels versus inflation. This
yeah,
is
so
kind of what we were talking about earlier, isn't it?
it is. Yeah, so that purple line is the inflation rate. It's down from about 9% to 3.5%. But the orange line is the price level, and it never comes back down unless there's deflation, which we oftentimes don't want because that's depression level stuff in deflation. It just stops climbing as fast. So when you hear news about disinflation or lower inflation, it's not deflation. Deflation is when prices come down. So when the Fed wins, prices don't return to 2019 prices. They just stop rising as quickly. So a family can be told truthfully that inflation is way down or slowing while at the same time staring at their grocery receipt, their receipt from the grocery store permanently 25% higher than it was 5 years ago. And that's not a contradiction. That's just the way the math works. And relief in the data doesn't feel like relief at the register. And on the
Two
next
different
slide,
things.
yeah, on the next slide
Yeah,
is this.
this I like this. Yeah.
So this is where, I'll just go quickly through this. Is when people argue about, hey, the economy's good, the economy's bad. The answer to that is they're actually both right. They're just living in different arms of the K. And the best example I like to give this is you and I both need to go buy $100 pair of Nike shoes. Elon Musk, the world's first trillionaire a couple months ago, wants to buy the same Nike pair of shoes. Like he's not going to feel that impact in the same way that you or I are going to feel that impact. And at different levels, as you get more and more people who are living paycheck to paycheck, they still need to buy shoes, but they're going to feel that way more from a how much it's going to hurt them to buy those shoes than maybe you or I are going to feel that when we buy that. So the averages that you read in the headlines blend two very different experiences and describe neither one of those experiences very well.
Well, in that lower K down here, I mean, you've got real costs that are wiping people's dollars out of their real bank accounts, as it's pointed, depleted savings, because everyday things are costing more. And we've
Yeah.
certainly seen in the world of insurance where uh, in your property and casualty world, those rates have gone through the roof in many cases, in many states. It's very difficult. Not everywhere is the same.
It's getting more expensive here in California, that's for sure. This next chart is really helpful to explain that a little bit deeper. So you see the left panel here, the labor compensation versus the corporate profits. This is the structural story underneath everything, in my opinion. If you go back before 2000, a larger share of the economic pie or the economic income went to workers' paychecks, and a smaller share went to corporate profits. That was healthy in a specific way, that when workers have money, they spend it at businesses. You get a paycheck, you go spend it at Amazon or Nike or whatever it's going to be. But over the last few decades, that has actually flipped, where labor's share of national income has drifted down while the corporate profit share has climbed. So wage earners are feeling the pinch. While this is key, while owners of businesses capture more and more of the pie based on the way things are structured. So here's what that tells me as somebody who builds portfolios in an economy where capital is capturing a growing share of national income. You want to be on the ownership side. You either own your own business or you own a piece of somebody else's business. And that's what owning stocks actually is. It's the second one. That's how we do it. Is we do it through stocks. So owning equities isn't a bet on the vibe, the economy. It's how households sit on the capital side of what has been working for the last 20 years instead of on the wage side. Anything to add on that, Doug?
Well, I would just say it gets back to even the point I made about the price of soup. I mean, you really recognize that as an employee, if all of us are in the workforce, if you will, and our percentage of everything is lower, the income part of our percentage of everything is lower. So this doesn't just mean people who work for a union. This means all labor.
And let's keep let's
Yeah.
keep talking about this. You see that the box on the top right, this that just shows you that the bottom 20% of wage earners earn about 3% of the pre-tax income, but they account for 9% of the spending. So they're spending three times their share, and they're probably having to borrow to maintain, especially as things get more and more expensive. And that holds across the bottom 60% of wage earners. Now, things roughly balance out in the 60 to 80% band, and the top 20% earn about 51% of the national income, but they spend only 38%, which gives them that surplus. And that surplus doesn't vanish, it begins to flow into risk assets. Those are the folks that are buying the stocks and the bonds and the real estate. It's that ownership mindset that they have. And in the bottom right chart here, since late 2019, you can see the top 20% has added about 48 trillion in net worth, while the other 80% have added about $17 trillion. Same economy, but very widely different balance sheets. So again, markets are pricing on corporate profits and spending of the households that do most of the spending. That's the upper arm of that K economy. We want to make sure that we're taking advantage of where the money's going to flow from that upper leg of that K economy. And that's going to continue to be having some stock ownership, even though sentiment tells you this just doesn't feel right to do that right now.
Well, and the reality is we need to think about the long term. Is we cannot we our only opportunity ultimately is to grow enough to sustain paying for our growing population globally. So we
Right.
just recently crossed 8.3 billion people on the globe, and it's growing. And so we have here in the U.S. We're actually growing very slowly at the same rate that China is shrinking, which is very interesting. But China has 1,100,000,000 more people than us, so don't think pretty soon they'll have fewer than us. They won't. So,
Right.
and India has 1,100,000,000 more billion people than us as well, and they're in a country one third our geographic size. So you look at that and our needs, somebody has to be producing something that pays for everything. And that's where ownership comes in.
Right.
Oh, I like this. So what sentiment tells investors, and Tim, you have some good things to say here. It's not what you think.
So again, we want to look at the next slide in regards to sentiment. So with a client base in the thousands, you can imagine we have every political viewpoint under the sun through our clients. And here's what I've watched for decades being in this industry, that most people feel that when the other party is in charge, the economy is about to fall apart and their sentiment drops accordingly. So you see here, Republicans felt great in 2017 through 2020. The Republican was it was a Republican administration, and then of course everybody sentiment collapses during COVID, which is understandable. But then the administration changes, and what you watch here is that the green line, the Democrat sentiment skyrockets up while the Republican sentiment drops through the floor. And then again in 2025, administration and political parties switch yet again. Republicans are now excited about the economy while Democrats are scared about what's going to happen in the economy. So the economy did not transform overnight on either date when the administration switched. What changed was who was in that White House, but the economy did not change. And the lesson that we learned from this is that we all view the economy through our own cloudy worldview or our own political bias. When the new party comes in, the out party wants to get defensive. And I've seen this with my own clients over the decades. The in party gets really excited and wants to invest aggressively, and then it reverses. But here's what matters for your money. No matter who held office over the past decade, the market did well across both administrations. Wanting to rebuild an investment plan around politics has actually never been a winning trade in either direction. So Just know that the surveys tell you what you're probably feeling. If you're on one side of the political party, oh, the other side's in, I don't feel as good, I'm scared. And that's what other people are also arguing. But the reality is, it has not yet impacted the way the market has responded over the last decade here. This is another one I think is worth mentioning. There's also in the sentiment data. There's a measurement quirk. Until May 2024, this survey used to be done by phone, and then it moved to the web. And this is important because if a nice person were to call you and ask you how you're doing, as a human, you're likely to soften it. Like, you don't want to sound like a doom and gloom mad person as you're speaking to a real stranger, a real human. But when you're filling out a survey form on the internet, you're going to let that survey have it. You're not going to hold back anything. So you might actually be a little bit more downbeat in your survey if the other party is in office, for example. So the doom and gloom reads deeper now that it's been a web-based response or web-based poll. But this chart, what you're seeing here, it actually corrects for these. It corrects by answering. We know lately that those who are responding lean more Democratic in these surveys and these polls. And right now, they're currently more downbeat in their surveys. But when we adjust for both political party as well as we make adjustments for, well, what are biases now that they're answering these questions via survey on the web versus phone, you see that the survey is not nearly as bad on the sentiment level when we make the adjustment for both. And that's the blue line. The dotted line is the headline survey news. That's what you're hearing and reading about. But when we make adjustments that most statisticians are going to make to say, well, how do we get the real data? The surveys are actually not nearly as gloom and doomy as being reported in the headlines there. That's the point of this chart.
Well, and that's an important point, as we look at the next slide, because people wonder, what does this have to do with investors? And incidentally, I'm sure everybody probably knows this, but the stock market is not the economy.
Right. Yeah, this is a helpful chart. This is just 50 plus years of sentiment peaks and troughs. And then next to each one, you see what the S&P 500 did over the following 12 months. So after 10 sentiment peaks, when everyone felt great, they liked what their prospects of the future were, the average next 12-month return was only 4.8%, about half of the historical average. And then after 9 troughs, when everyone felt awful, it was about 24.1% over the next 12 months, which is more than double the historical long run, 100-year return. So it's backwards from instinct. The best forward returns of the last half century came when people felt worst, and the weakest came when everything felt terrific. So just know that when you feel terrible, that's probably a really good time to be owning stocks. And when you feel great, then maybe it's a conversation to have. But then we have to remember, it depends on what political party you are, right? So that's why we're not necessarily looking at the headlines and looking at sentiments and saying, well, people think this is going to happen because of the Iran war. We want to look at what actually matters, which is earnings and all the other data that we have to tell us what we should be doing in your portfolio.
Well, and we see, headlines often drive investor behavior, which is what we're trying to help our clients avoid. We don't want headlines to drive the behavior. Warren Buffett has been, and I'll paraphrase, known to have said many times, markets are the world's way of transferring wealth from irrational people to rational people.
Yeah.
And that irrationality is stimulated by the emotions we feel by all the volatility. So the real cost of letting feelings drive money decisions. Talk about this, Tim.
I'll be just quick here. But none of these people are foolish in this chart. I mean, everyone is a natural human, and it's just a natural human response to what we saw in these earlier slides. But this is exactly why we need a process to be built before the emotion shows up. So if you put yourself in any one of these baskets, that's normal. I mean, I do this exact same thing, and I've been managing money for decades. I feel it because I'm human, which is why it's very, very vital to have a plan built ahead of time before the emotion sinks in. That's really what this is saying here.
Well, and that's important. And incidentally, we've mentioned this in previous programs, but One of the industry watchdogs that we pay attention to is an organization called Delbar. Delbar, Dalbar, produces every year something they call the quantitative analysis of investor behavior. And basically, what the analysis says year after year is that over any period of time, investments will work better than investors.
Yeah.
And the nut of the story the begs the question, why will investments work better than investors? And the answer is investors are influenced by feelings, emotions. The word feelings here is the same, is used interchangeably with the word emotions. So investors are influenced by feelings, by emotions. Investments are not.
Yeah.
And so it's real important that we not make these really short-term decisions or these long-term with long-term consequences based on how we're feeling in the moment. And that's why we want to position you such that whenever you need money, there's a smart place to get it. And so that you don't have to concern yourself on a daily basis. This is what we do. And Tim is one of those who actually does it for real. So I'm going to let you share with everybody, what do you really do?
Well, so what we do here at TMG is to help with those emotions, right? One of the buckets on the previous slide was when our emotions begin to rise and we get fearful, we start to check our accounts more, and then that causes us to want to make those decisions. Which, as Doug was talking, you're talking about the Dalbar studies. A typical investor in an S&P fund makes 6%, where the fund makes 9. I don't know what the exact numbers are, but it's something along those lines, costing the average investor in a S&P fund millions of dollars over their lifetime. And we like to think that we're above average, but we're not. I mean, we're all average when it comes to millions of different people. So what we try to do
Not
to
those of us from Minnesota, Tim. We're from Lake Wobegon is here, you know. So for those Prairie Home Companion fans out there,
everyone's above average there.
yes, and like Lake Wobegon.
Yeah. So what we try to do to avoid those very, very, very costly, sometimes in the millions of dollars over a 30-year plan, is develop a plan that's tied to your goals, not the headlines. We try to encourage you not to read the headlines. There's usually nothing good that comes out of that. And then we try to make tax aware decisions so that a reaction doesn't hand you an avoidable tax bill. So the idea is, we don't mind the volatility. In fact, I personally would love if stocks pulled back here because it'd be a great opportunity to do some Roth conversions or maybe do some rebalancing to take advantage of lower prices for the next 20 or 30 years. I told my daughter, she just started investing, she's 21. The best thing that can happen for you is that the market would pull back a little bit, because as you're putting money in, you're gaining more shares that's going to benefit you 20, 30 years down the road. And then we look at, cash flow and reserve planning so that if you have a short-term need, it never forces you to sell anything at a bad time. We don't want to have everything invested all in stocks pull back, 20% or 10, 20%, and you need money. We want to plan for those moments so where we don't have to pull that money from having to sell stocks while they're down. We've got a pile of money that we've thought through and planned through of where you can fund your living expenses, and then we can take advantage of those lower stock prices that can benefit you again over the next 20, 30 years. And then we regularly review these plans to make sure that you continue to be on track, no matter where the stock market is, up, down, sideways. But we want to make sure we continue to review that with you.
Well, this is and I will say, having had a chance to spend more time with the Mather Group over these last few years, that I have been duly impressed with the incredible quality of the tax strategists, the investment team, the financial advisors themselves. What we have are people who want to make clear for you 2 points. One, we genuinely, all of us, we joined this company because we genuinely want to help. And then the other thing that I can tell you now, having been with this team for a while, we absolutely can. And so let's look at some key takeaways, and it's 4 o'clock, so we can wrap it up here real quickly. Any quick? I'll let you do it, Tim.
Yeah, just I mean the gap between how the economy feels and what the data shows is real, it's measurable, and it has a name. Households and markets respond to different things. You just need to remember that. So both views can be true at once. Historically, the strongest returns are going to come when things feel the worst across the country. When pessimism's bad, not at peak optimism. So if you're reading things, you're feeling bad. Just know that we're watching what the markets are doing, and we're making those decisions for you. We want to make sure that we're helping you, but because we have a plan, eliminate whatever the emotions make you feel like you want to do. We want to take the emotions out of your future success in your financial plan. Thanks for letting me fill in for Adam as well.
Hey, Tim, thanks for being here. And thanks to all of you. Without you, we have no show. So please come back next month and please encourage everybody you know to watch us. We want to provide some enlightenment and we hope we can help our clients and those who aren't yet our clients improve their own behavior and have the quality return on life they would like. Thanks very much. Goodbye.